Hello and welcome to our Finance Act 13 update. My name is Karen Bullen. I am the head of Tolley's Centre at Manchester, and what we're going to have a look at in this talk is the personal income tax changes that have been brought about by the Finance Act 13. Now, the personal allowance has gone up a little bit, but remember, once your earnings exceed 100,000, we start whittling away the personal allowance. We reduce it by £1 for every £2 excess. And where your income is in that band where we are losing our personal allowance, that income is effectively suffering 60% tax. And so now with the increase to 9440 of our personal allowance, that 60% band is that first £18,880 above the 100k limit. Now, thinking of our exam situation, if we're asked to offer advice to a client and we can see a client whose income is in this band 100,000 up to 18,880, then we should be advising him to bring his income down. So maybe by making a pension contribution or even thinking about gift aid. But of course, with a pension contribution, you're actually sort of saving efficiently for yourself for your future. Also made at the same time was announcements on the future rates of personal allowances. The aim of the government is to get the personal allowance up to £10,000. But the other side of that is they're bringing the basic rate tax band down so that we're finding that there's not a big change in the point at which someone will start hitting the 40% tax band, as you can see in this table here. Again, thinking of advice in the exam when we're looking at our ATT paper 1 or our advisory individuals paper, what we need to be looking for is someone, let's say, paying a salary out of their own company. Then you always want to try and make that the most efficient extraction of funds as possible. And what we tend to say is, oh, well, you should set your salary at the employer threshold for national insurance. And then, of course, you can pay the salary, comes out of the company profits, reduces profits chargeable to corporation tax, and you don't have any NIC consequences. But what we're finding now, as the personal allowance increases, is that the gap between the employer threshold and the personal allowance is getting bigger and bigger and bigger. And so we're going to have a little bit of a dilemma here. You could save corporation tax by increasing your salary to the level of the personal allowance, and so the individual can get the salary covered by the personal allowance, don't have to pay income tax. But, of course, that would then be at the expense of national insurance. So, again, it's something we're going to have to weigh up if we come across a scenario like this in our real exam. Something else that's new that was brought in by Finance Act 13 is a cap on certain reliefs for income tax. Now, from the start of our tax year, so 6 April 13, uncapped income tax reliefs are now going to be restricted to the higher of 50,000 or 25% of your adjusted income. And your adjusted income is your net income for income tax purposes after any pension contributions and gift aid, charitable gifts, that sort of thing. Now, the actual charitable gifts themselves will not be subject to any sort of cap at all, but it's other things like losses that will be capped. So using your losses where you're offsetting them against your other income. And also situations where you have borrowed money, you are paying interest, and we want to claim a deduction for that interest against your income. These reliefs are going to be capped. So let's have a look at a couple of examples. In this example here, Jack has a total income of £160,000. He wants to claim relief for £75,000 of trading losses in the year. Unfortunately, the greater of 50,000 or 25% of his total income, 25% of his total income was 40,000, so the greater of 50 and 40 is 50, says that only 50,000 of his loss can be relieved in the tax year in this way. If we're looking at an interest payment, we've got Jill, her total income is 400,000 in the year. She has paid qualifying loan interest, so that would, let's say, be on a loan to buy into a close company or a loan to a partnership, that sort of thing, of 125,000. Unfortunately for her, the greater of 50,000 or 25% of her income is 100,000. She's only going to be allowed to deduct £100,000 of that loan interest from her income. So we've got these restrictions now, and the thing to watch out for in the exam is where you're looking at deducting this interest, qualifying loan interest, and also losses. Those are the two main ones to watch out for in our exams. Car benefit-wise, well, basically, the car benefit is going up and up and up over the next few years. So, again, all I would say to you is just read your tax tables carefully. Remember, our tax year in the exam is 13-14, but bear in mind that if you're giving advice to a client, the car benefit is going to increase in future years. In fact, by 16-17, all the rates will have increased by 2%, although the diesel supplement of 3% is going to be abolished. So all we really need to take home is that car benefits are going to increase over the next few years, and so maybe the advice you might be giving in the exam is whether the client needs to consider if a company car is a viable option going forward. With pensions, the lifetime allowance is being reduced to 1.25 million. The annual allowance is being reduced to 40,000 from 50,000. Now, with the annual allowance, if there's any unused annual allowance in the 3 years prior to your current tax year, you can use that up in this year as well. And when you're looking at your prior 3 years, still use 50,000 as the then annual allowance, so that's what you will compare to what's being paid to see what the unused amount is. But the annual allowance in our year, 13-14, is, 14-15 is going to be £40,000. So we know it's 50,000 at the moment. We know it's about to go down to 40,000. So your advice is going to be, maybe you want to take that extra bit of amount into your pension this year rather than next year. As a general rule, we're not really supposed to know what happens in the future unless it's already been announced. And so if it has already been announced, like this one here where the annual allowance is going down, then do try and bring it into your answer to your ATT and your CTA question as long as you feel it is relevant, obviously. So, next thing I want to have a look at is something new called the employee shareholder status. Now, this has been brought in presumably by the government because it thinks it's going to improve the flexibility in the labour market. And what it's basically doing is saying that for certain employees, and these are called employee shareholders, they are going to agree to a change in their employment rights. So this employee agrees with the employer to accept a reduction in their employee rights. And the sort of rights that are going to change are things like unfair dismissal, flexible working, statutory redundancy pay, and also these people are going to have to give slightly longer notice periods when it comes to maternity and paternity leave. Now, they will agree to this reduction in rights in return for a payoff of shares in the employing company. Now, this new employee shareholder status only came into effect from 1 September 13. So remember, that's only part way through our 13-14 tax year. Various impacts. Let's start off with the income tax treatment. What's basically going to happen is we're going to pretend that these shares, the employee paid £2,000 towards having the shares. So the normal rule is if your employer gives you freebie shares, let's say they give you £3,000 worth of shares and you pay nothing, you normally have £3,000 for employment income. But what's going to happen here is we're going to pretend you paid £2,000 for those shares. So 3,000 minus 2 says you'd only have £1,000 of employment income in that scenario. Now, there's no £2,000 deduction if this employee shareholder has a material interest in the company. Material interest is defined as 25%. What's going to happen is the shares are going to be agreed with the share valuation division of HMRC prior to the award, if you don't know what they're worth. And remember, all things to do with shares, as a general rule, most things to do with shares are reported on Form 42. The capital gains tax treatment, well, it's really generous, the capital gains tax treatment, because it says a disposal of shares worth up to £50,000 on acquisition are going to be completely exempt from CGT. But again, that exemption does not apply to anyone who had a material interest in the company in the prior 12 months. Now, normally, if I make a transfer to my spouse or my civil partner, that transfer is always at a no-gain, no-loss price. But this is not the case with these shares. Any transfer to your spouse or your civil partner is going to take place at market value. The employee then gets their exemption on that first £50,000 worth of shares, and the spouse acquires the shares at market value, so that becomes their base cost for any future disposal. For the company itself, there's a corporation tax deduction, and a corporation tax relief is given on the value of shares awarded to the employee shareholders under the scheme, and that value is the full value. You basically ignore the £2,000 deemed payment. So you pretend that that didn't happen. So it's win-win, I suppose, all round, apart from the employee losing their employment rights. So for the employers, they've got to make sure that this is a genuine agreement with the employee and that you're not going to allow people who have a material interest in the company to benefit. No selection is available for the rights that the employee surrenders, so they're going to have to surrender all of those rights. But the employee must receive independent legal advice, which the employer has to pay for, so that they know exactly what's happening here. They're going into this with their eyes open. They're not just seeing, ooh, free shares here. They're actually aware of what it really means for them. Now, probably the biggest thing that's changed from a personal tax point of view with the Finance Act 13 is the statutory residence test. And so instead of all the rules we used to have on whether someone's resident or ordinarily resident in the UK, they've all gone out the window now. From the 6th of April 13 onwards, we have this brand new test. And it's effective for income tax and capital gains tax, and then also inheritance tax and corporation tax if you need to know the residence of an individual. Let's just get a little bit used to the terminology that's used. It's P is resident, so P is the person, resident in the UK for a year, X being the year. That's the terminology that they use in the legislation. Now, the statutory residence test is supposed to try and make everything a little bit more cut and dried when you're trying to work out whether someone is resident in the UK or not. And basically, there are 3 tests, and I want you to conduct the tests in this order. You do the automatic overseas test first, then the automatic UK test, and finally, you're down to the 3rd test, which I'm going to call the tiebreaker. That's the sufficient ties test. Now, if you do the automatic overseas test and you say, yes, I passed one of these tests, then automatically you are not UK resident. Don't look at any other tests. If you don't pass the automatic overseas test, then you will look at the automatic UK test. Pass any of those, you are automatically UK resident. Stop there. Only if you fail both of those first 2 tests do you go down to the tiebreaker test, the sufficient ties test. So, your starting point in the exam is always the automatic overseas test. Now, there are 5 tests, but 2 of them only apply in the year of death. So, unless it's a year of death, ignore those 2. Just look at the other 3 tests. The other 3 tests, is the 16-day test, 46-day test, overseas work test. If you meet any of those three tests, you are automatically resident overseas, i.e. not UK resident. Now, the 16-day test says if a person was UK resident in any of the last 3 years, but for this year they are in the UK for less than 16 days, then they are automatically not resident. Again, we're sort of ignoring the death bit, but because that's quite an unusual scenario and not as likely to crop up, I would say, in our exam. The 46-day test says the person was not resident in the UK in any of the last 3 years. If they spend less than 46 days in the UK in this tax year, then they are not resident in the UK. So with the previous test, if you were resident in any of the previous 3 years, you're looking at 16 days in the UK. If you're not resident in any of the last 3 years, then you've got slightly more days allowance in the UK, 46, and you'll still be non-resident. The third test is the overseas working test. Now this is much more complicated. If you are full-time working abroad, then you're not resident in the UK. But it's a bit more complicated than that. So let's work down through the slide. P works sufficient hours overseas as assessed for year X, and sufficient hours would be 35 hours or more per week. During year X, there are no significant breaks in your overseas work. A significant break is when you take more than 31 consecutive days off work. P works more than 3 hours in the UK on less than 31 days, and the number of days actually spent in the UK are less than 91. And you don't count deemed days for this test, and I'm going to explain what deemed days are a little bit later. Now, I suppose you could learn all of these rules, but let's be honest, who wants to learn all of these rules? This is going to be a situation where to prepare yourself for this question in the exam, you've got to have the legislation highlighted. So you've got to get your Finance Act 13 in front of you, and you need to highlight it up. So you need to highlight it in a way that if you had to do this test or you had to talk about this test, you're ready to go. You're ready for action in the exam. So let's have a look at an example. Mailing, worked in Italy for an average of 8 hours a day. Now, she's doing that for 5 days a week, and this was what was the working pattern between 6th April and 23rd of August in our tax year that we're looking at, which is 20 weeks long. Now, during that time, she took 9 days annual leave. Then she toured Italy for 30 days, and then she took up a new job in Italy and worked 23rd September to 5 April in the new job, where she works 9.5 hours a day from Monday to Thursday, but just works 4 hours on a Friday. She also took 5 days of annual leave, and then 10 days of annual leave with a weekend in the middle of that, and she also had 5 days sick. Now, when you get your legislation open in front of you, you're going to notice that there are different steps you have to go through to do this overseas working test. Step 1 says you need to look at your disregarded days. Now, this is any day where there's more than 3 hours of work in the UK. Now, in our example here, she never worked in the UK at all, so we're going to have nil disregarded days for this example. Step 2 says you need to work out the net overseas hours. So you look at the hours she worked for employer 1, employer 2, add them together. So here we've got what, 1,736 hours of work. That's step 2. Step 3 says you're looking at a reference period. Now, the reference period starts with 365 days, and then you have to deduct various things. So you deduct your disregarded days. That was nil for our example. You deduct your days on leave. You deduct your sick days. And so there's various things you have to deduct, and these really need to just be highlighted in your legislation. So you then get left with a certain number of days. You convert those days to weeks. You look at the hours you've been working. So effectively, you work out your average hours per week, and we need that to be more than 35 hours per week. So in our example here, we've got to 38.57. So that's more than 35 hours per week. So she's met the hours per week test. So that's at least to get to one bit of it. There's been no significant breaks in her overseas work. She works more than 3 hours in the UK on less than 31 days. Well, here she didn't work any days in the UK, so that's fine. And a number of days in the UK was less than 91, which it was. So she meets the automatic non-resident test because of overseas work. But then actually, if you'd have gone back to this example and you'd actually looked at it following the 3 steps we should have looked at, she also met the 16-day test, and she also met the 46-day test. And you only have to meet any of the 3 tests to be automatically non-resident. So that's why I would always say start with the 16-day test, then the 46-day test, because those 2 are much, much easier to look at in the exam before you get yourself into the nitty-gritty of the overseas working test. So, automatic overseas tests, there are 5 of them, but 2 of them only count on death, so we'll ignore those a little bit because they're not going to be as highly topical as the other 3 tests. You meet any of those 3 tests and you're not UK resident. You don't meet any of the 3 tests, then you've got to move down to step 2, which is the automatic UK test. Okay, so 4 automatic UK tests, 183-day test, home test, UK working test, and then a test for the year of death. So again, year of death, not very likely in the exam, so really again, 3 tests to worry about. So, 183-day test, nice and straightforward. Is P present in the UK for at least 183 days in the tax year? If you are automatically UK resident. Home test. If P has a home in the UK during all or part of the year, he will be automatically UK resident. Now, a little bit more to this test. For the home test to be satisfied, he is present at that UK home for a sufficient amount of time, so that's at least 30 days or part days, and while he has that UK home, there's a period of 91 consecutive days, of which at least 30 of those 91 days falls into the tax year we're looking at. So we need to find a period of 91 consecutive days, could fall all or part way into our tax year, throughout which P does not occupy an overseas home for more than 30 days or more. So let's have a look at this example here with Jane. Jane has a home in the UK and is present in that UK home for more than 30 days during 13-14, but she acquires an overseas home on the 1st of March 14 and is present there for 30 days in our 13-14 tax year. So let's have a look at whether she meets the home test. She meets the UK home condition because when we have a look at it, there is a 91-day consecutive period. And if you just look at from 6 April 13 to 28 February 2014, in that period of time, there's at least 91 consecutive days when she had a UK home, and that's the only home she had. So at that point in time, she didn't have the overseas home. If she had the overseas home, if she'd have spent more than 30 days in it, we would have been okay getting out of this home test, but she didn't even have the overseas home. So she's met that condition. She's going to be resident in the UK in 13-14 under the home test. So again, it's a bit more complicated, and again, you must highlight your legislation to help you answer questions on this in the exam. The third test is the UK working test. You meet the UK working test if P works sufficient hours in the UK, as assessed over a 365-day period. And during that period, there are no significant breaks from UK work. So a significant break is more than 31 days taken together where you're working less than 3 hours, and all or part of the period falls within year X. So you're looking at any 365-day period of which parts of that, or maybe all of it, falls into the current tax year that you're studying. And more than 75% of the days in which P works more than 3 hours are UK work days, and at least one day in year X is a UK work day. Because remember, this 365-day period could be partly in our year X and partly in another year. So here we are, once again, where we're looking at lots of different conditions, and you really need to have these all highlighted in your legislation. Okay. So, let's have a look again at our 3 tests. We have the automatic overseas test. Pass this, you're automatically not UK resident. If you don't pass that test, then you look at the automatic UK residence test. Pass anything in that test, and you're UK resident. If you don't pass that test, then you're down to this tiebreaker test, which is the sufficient ties test. Now, the sufficient ties test looks at the number of UK ties that an individual has and combines that with the number of days that they spend in the UK to see if they are going to be treated as UK residents or not. As a general rule, the less ties you have, the more days you can be in the UK without being UK resident. Now, potentially, there are 5 ties that we could look at: family tie, accommodation tie, work tie, the 90-day tie, and finally the country tie. But the country tie does not apply if someone's been non-resident in any of the 3 previous years. And again, you know, you're going to have to highlight all of these in the legislation. So the family tie, basically, if you've got family in the UK, so your spouse, your civil partner, your child is in the UK, then you have a family tie to the UK. The accommodation tie, if you have a place to live in the UK, now this doesn't have to be a place that you personally own. I mean, if your parents are in the UK and you can stay at their house whenever you come to the UK, then that could be an accommodation tie. So you have a place to live in the UK, it's available to you for at least 91 consecutive days in the tax year, you spend at least 1 night there in the tax year, then you could have an accommodation tie to the UK. If it's the home of a close relative, then you do actually need to spend at least 16 days there. When we're looking at an accommodation tie, we wouldn't include hotels or something like that. Work tie, you have a work tie to the UK if you work for at least 40 days in the UK in the tax year, and a working day is a day where you're working more than 3 hours per day. Ooh, that would be nice, wouldn't it? The 90-day tie is that you spent more than 90 days in the UK in either year X1 or year X2. So this year or last year. Oh, sorry, year X1, X minus 1. So we're looking at year X, so it's year X minus 1 or year X minus 2. So in other words, the 2 tax years prior to the current tax year, because the current tax year we're looking at is year X. Sorry about that. Or the country tie. Now, the country tie only applies if you have been UK resident in any of the 3 preceding tax years. If you spend more days in the UK than anywhere else, then you have a country tie. So this is to catch people who are leaving the UK. So they have been resident in the UK in any of the 3 preceding tax years, they're now sort of leaving the UK. If they spend more days in the UK than they spent anywhere else in the world, then they have a country tie to the UK. So we look at the number of ties a person has, we look at the number of days they're actually in the UK, and you're in the UK if you were here at midnight, but I'll look at that in more detail in a moment. And then we compare those two factors to two tables. Now again, these are in your legislation. Table 1 is for what we will call leavers. You are a leaver if you are resident in at least one of the last 3 tax years. And as you can see, if you spend less than 16 days in the UK, then you're always non-resident. If you have spent between 16 and 45 days, then we will treat you as resident if you've got 4 factors. 46 to 90 days, you're only resident if you've got 3 factors. 91 to 120 days, you're resident if you have 2 factors. 121 to 182 days, you're resident if you have 1 factor. 183 days or more, you're definitely resident in the UK. So you can see that the more factors you have, the less days it takes to get you into residence for the UK in that year. Slightly different table for arrivers, as you can see here. Less than 46, an arriver, I should say, is someone who was not resident in any of the previous 3 tax years. If you spend less than 46 days in the UK, then you are non-resident. We should have picked that up under the non-residence test anyhow. You will be resident in the UK if you have all 4 factors and spend between 46 and 90 days in the UK. You're resident if you have 3 factors and spend between 91 and 120 days, and resident if you have 2 factors and you're between 121 and 182 days. If you spend 183 days or more, then you're always resident in the UK, and we should have caught that under the automatic residence test. So these 2 tables, again, they're in your legislation. You need to have them highlighted. So, counting days is really crucial for us now to perform the statutory residence test. And basically, what you're going to find is individuals have got to keep a very detailed diary of where they are every day. And if you are in the UK at midnight, then you are in the UK for that day. Now, there are a few sort of get-out-of-jail-free cards, such as you're a transit passenger, so you're travelling through Heathrow or something, or other unforeseen circumstances. But basically, you're in the UK at midnight, we'll count that day. What we've also got is a deemed days rule, and this is to stop people, let's say, for example, living in the Isle of Man, flying into Manchester to work in Manchester for the day, and then flying out in the evening, so they're not actually in the UK at midnight, even though they were present in the UK in that day. Now, that's called a qualifying day. And once we have 30 qualifying days, any remaining qualifying days are going to start being counted towards your days in the UK, even though you're not actually there at midnight. Now, this deemed days rule only applies if you have at least 3 UK ties and the person was resident in any of the preceding 3 years. So, here's our overall approach. We have the automatic overseas test, automatically not UK resident. Next test, automatically UK resident. Final test, the tiebreaker test, where you look at the number of ties someone has in the UK and the number of days they've spent in the UK. Now, you must do these 3 tests in this order. If whatever test you've done, you have worked out that someone is UK resident in the current tax year, then the normal rule is you treat them as resident for the whole tax year. But in 8 specific circumstances, you can split the tax year between a resident and a non-resident part. So if someone is leaving the UK partway through the tax year, you can have the first bit of the year as UK resident and then the bit after they've gone as non-resident. But you only get this split year treatment in 8 particular circumstances, which are called 8 cases. And 3 of the cases will apply to people who are leaving the UK, and the other cases, the other 5, apply to people who are arriving in the UK. And so it's things like you're starting to work overseas, or you're accompanying your partner who's starting to work overseas, or you cease to have a home in the UK. So those are the three cases where you are leaving the UK. When we're looking at arriving in the UK, you might be starting full-time work in the UK, or you might be returning to the UK after working overseas, or accompanying your partner who's just done that, or maybe you're starting to have a home in the UK. So there are various cases. Again, they're all in the legislation. You need to have them highlighted up, ready to go, that you could talk about them or you could apply them. If you get the split year treatment, then as I've said, we will be splitting year into a resident and a non-resident bit. If you do not get the split year treatment, then you're going to be resident for the whole of the tax year, even though you are leaving or arriving part way through that year. The one bit of good news, I suppose, is that the term ordinary residence has now gone. That concept is completely abolished, although that did affect very few people in the UK, but that has now gone. Right, well, I hope you have found this talk interesting. There's an awful lot of new stuff in there, especially statutory residence rule, the statutory residence test rather. That is something you really have to sit down with your Finance Act 13 in front of you and get it highlighted. Get it ready for that question in the exam. Good, I hope you've enjoyed this, and good luck with your studies.